Hello everyone, we are going to discuss the consolidated statement of financial position in 2017 past papers. Let's see the question. Mount PLC acquired 240,000 ordinary shares and 100,000 preference shares of Sun PLC as at 1st April 2016 when it has 4,400,000 amount of retained earnings and 8,000 amount of general reserve. We have been given the first information. There were 300 ordinary shares and 250 preference shares at the date of acquisition. Then the Mount PLC is considered as the parent company and Sun PLC is considered as the subsidiary company. Next, see how much has been acquired. The information tells us that there are 300 ordinary shares and 250 preference shares as of the acquisition date, out of which 240 ordinary shares and 100 preference shares were. If we take it as a percentage, ordinary shares are 80% and preference shares are 40%. Now, as of the date of acquisition and date of reporting, all equities are summarized as follows. Now I invite Kasun to discuss the next information. Thank you.
Thank you, Abdul. Now let's go to the next information. 50% of difference of current account balance is due to cash in transit and rest is due to goods. Let's see how the current account balance is. Current account is Sun PLC 180, current account is Mum PLC 120. Difference of current account balance is 60 rupees. Now calculation of 50% of difference. 60 multiplied 50%. After that, 30 rupees goes to cash in transit and goods in transit. The statement of financial position states that under current assets, 30 rupees is inventory as good in transit. 30 rupees is cash in transit. Next I invite Manshika to discuss next information.
Thank you. Okay, let's see what is given as the third information. Sun PLC sells goods to Mount PLC at the profit margin of 25% on cost. Invoice value of rupees 350,000 mounted goods has been sold during the year and 30% of it remaining as unsold at the end of the year as a part of its closing stock. The profit margin is 25%. That means if the cost is 100, they will keep a profit of 25 and sells it for 125. How we are told that 30% of the invoice price of 350 has not been unsold. When we look at 30% of 350, we got 150 stock as unsold stocks. Next, we need to remove the profit from the unsold stocks and the 30 rupees that were put as good in transit. The profit is 150 unsold goods and 30 rupees transit is found by multiplying by 25 and divided by 125. Then we get 21 rupees profit of unsold goods and 6 rupees profit of goods in transit. deducted from the inventory in the statement of financial position as 27 unrealized profit. Thank you. Next, I invite Kasim to discuss next information.
Next information is 8,000 rupees of account receivable balance of MAM PLC is to be settled by Sun PLC. It is said here that Sun PLC has paid 8,000 of the money that Sun PLC had to be paid to MAM PLC. After such payment, 8 rupees deducted from the accounts receivable of MAM PLC and 80 is rupees deducted from the accounts payable of Sun PLC. This is how it shows the statement of financial position. Next, I invite Janoli to.
Thank you, Kasun. We are on to the next slide. According to the impairment test, the goodwill has to be devalued by 20,000. We have calculated goodwill. First, ordinary shares, preference shares, general reserves, and dividends from deduct by investment. Investment value is 40,500, ordinary shares 30,000, general reserve 800, return earning 40,400, value 8,200 multiplied 8%, value 6,560, deducted by 7,940. Preference shares 2,500 multiplied for 40%, value 1,000, deducted by investment, value 8,200 multiplied 8%, value 6,580, 60, deducted by investment. Preference shares 2,500 multiplied 40%, value 1,000, deducted by investment 6,940, match impairment of goodwill 20,920. We are going to the next slide. During the year 2016-17, Sun PLC paid ordinary shares dividend as 20% based on the capital. They are used pre-acquisition profit in the payout is dividend. We are first, how many shares in the company? Value 30,000 multiply 20%, value the get value. We have to pay dividends only 60 shares, 100 shares. Therefore, after calculates 8% of 100. Get we have to pay dividends only those 600. Therefore, after calculate 80% for 600 shares, value is 480. After the 480, we deducted by goodwill. Finally, goodwill value is 6,440. It shows SSP under NCI. That's NCA. Thank you. Maheshika conduct by next slide.
Thank you, Jonathan. Now let's see how to calculate consolidated general reserve, retained earnings and non-controlling interest. First, we calculate the consolidated general reserve. In the statement of financial position, Mark PLC has a general reserve 4,000 and 80% of post-acquisition general reserve 29. Then we get 4,160 as consolidated general reserve. Next is consolidated retained earnings. In the final statement of financial position, Mark PLC has a retained earnings 5,600 and 80% of post-acquisition retained earnings minus 500. Then we get 5,200 and from the 20 rupees of impairment, 27 rupees of unrealized profit, 480 from dividends should be deducted from retained earnings. Then you get 4,673 as consolidated retained earnings. Now I calculate non-controlling interest. Non-controlling interest is calculated by calculating 20% of ordinary shares, general reserve and retained earnings and 60% of preference shares. Then as non-controlling interest we get 3,080. The consolidated general reserve, retained earnings and non-controlling interest recorded of the statement of financial position under equity. The consolidated general reserve is 401,060 rupees and consolidated retained earnings 404,673 and non-controlling interest is 3,080. Thank you. Now I invite to Rami to complete the statement of financial position.
Equipment 4,000. Mouse PLC. TV Sans PLC 7,000. Depreciation Mouse PLC Depreciation Sans PLC Goodwill Inventory cash in transit, third payments, holding and 3,000. Cash in next, third plus cash in hand, total Association Road. End of the our session.